ServiceNow is a company that uses artificial intelligence to help enterprises employ agentic AI for both external and internal use cases. So, understandably, investors are excited about this business. I've had this stock rated as a buy for some time now, and in this video, I'll update that recommendation and let you know if I still think this stock is a buy or if I'm downgrading it to a hold or even a sell. I'm going to review the company's revenue growth projections. I'm going to review its operating profit margin growth. I'm going to review its cash flow from operations to sales ratio and look at the company's returns on invested capital. Finally, I'll look at the valuation as it stands today, March 4th, 2025, to give you my updated recommendation on ServiceNow stock. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Starting with revenue growth, looking back over the previous 5 years, you'll notice that it's decelerated for ServiceNow. What that means is the rate of increase is decreasing, the second derivative. Now, ServiceNow has generated strong revenue growth for several years now, consistently above 20%. And the company recently made an acquisition that's a good plug and play for the company that could facilitate further revenue growth as it adds that company's services to the overall services that it offers. Furthermore, the service that it offers is highly in demand from corporations that are looking to improve employee productivity. So revenue growth is likely to persist for several years for ServiceNow. More impressively than the company's revenue growth is the operating margin expansion. At 12.42%, it's much higher than the roughly 3.5% the company generated in 2020. I'm attracted to companies that expand their profit margins as revenue expands. I like to see revenue growth that leads to better profit margins. It demonstrates to me that the company has foundational economies in scale built into the business model. It also demonstrates to me that the company is learning how to serve their customers more effectively. You should get better as a business over time. You should learn what your customers want, and you should learn how to deliver those services to your customers more effectively over time. Hopefully, you can say the same about my channel. If you look at my videos from 2022, when I just started on YouTube, and you look at my videos today, hopefully you can say that you've seen great improvement in my channel. And that's what I expect to see from businesses as well. As you learn how to do the things that you do, I want to see improvement, and that improvement is demonstrated in your margins, in your cash flow from operations, most notably. And I do see that with ServiceNow, and I have seen that with ServiceNow for several years now. It's one of the main reasons, combined with, of course, the category and the product it offers, the customer value proposition. It's one of the reasons why I've recommended ServiceNow stock as a buy before. Now, its cash flow from operations is even more impressive than the operating profit margin. The main difference is ServiceNow uses significant sums of stock-based compensation, which is paying your employees in pieces of the business instead of paying them in cash. So you tell your workers, are you willing to accept shares of the business instead of taking cash? Sometimes employees prefer that because then they feel more intertwined with the business. Then they feel more motivated to do a good job because they have shares of the business. And so if they and their teams perform well, the business does well, the business profit soars, the stock price increases, and their wealth increases. Instead of just getting a weekly paycheck or a monthly paycheck, they get shares of the business, which is more motivating for some employees. ServiceNow uses this to a great extent. And when you're using stock-based compensation, it's a non-cash expense because you're not giving out cash. You're giving out shares of the business. So on your income statement, you have to record that as an expense But on your cash flow from operations statement, you don't include that as a negative in cash flow. And so that creates that difference between operating margin and cash flow from operations to sales, which you do see with ServiceNow. The operating margin is at 12.5%, but the cash flow margin is at 39%, a big difference, right? And I see this with several companies like ServiceNow, companies like DocuSign, Palantir, UiPath, companies that are using this stock-based compensation have these similar differences. Now, this does dilute shareholders, and what that means is you're giving out more shares of the business, and so the existing profit of the business is split among more shares. And so that has the effect of lowering the earnings per share unless the overall profits of the company are expanding faster than you're expanding the number of shares outstanding. So there is that give and take between using stock-based compensation instead of paying employees in cash. But in most cases, I'm okay with companies using stock-based compensation, especially when companies are still growing, because that allows them to conserve cash, use the cash for growth, and then when they're mature and they're generating more cash flow, they can use that cash flow that they generate and buy back shares of stock and thereby reduce those impacts of shareholder dilution, which ServiceNow is already starting to do, starting to think about buying back some of its shares to reduce the impact of this stock-based compensation. Return on invested capital measures how good a company is at using investor capital to invest in products and services that creates profit. ServiceNow has done a good job with this metric at 14.04% for a company in the early stages of growth. This is a good number. Longer term, you'd like to see this number moving higher. And I've seen a lot of volatility in ServiceNow in this metric. The company's return on invested capital is fluctuating up and down. I don't see a clear uptrend in this metric. But that's okay in the early stages as they are investing in new products and services to serve this massive opportunity. And finally, I wanted to look at its valuation. Measuring on a forward price to earnings is trading at a forward PE of 45, which is near the lower end of where the stock has traded for according to this metric in the last year. And then on a price to free cash flow basis, it's trading at 56. Now, these are not cheap valuations, but that's okay because ServiceNow deserves a premium valuation. It's generating revenue growth above 20%. It's operating in a market that's expanding rapidly, so a very attractive market opportunity. It's expanding its operating profit margins. Its cash flow from operations is improving, and it's already at a very strong number. So it deserves a premium valuation, one that I think could even be more expensive, and I would still rate the stock as a buy. So at these valuations, I certainly do rate ServiceNow stock as a buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.